Hi friends, in this video I want to speak about 3 beaten down stocks and give you data and facts so that we can understand whether it is the lifetime opportunity to invest in any of these 3 stocks or whether it is going to be a trap to invest in these 3 stocks. Without wasting even a single second, let's get to stock number 1. Stock number 1 is Kotak Mahindra Bank. 3 to 4 critical points that I want you to understand in the next 4 to 5 minutes, and these points no one is speaking about. For me to explain to you point number 1, have a look at the price history of Kotak Mahindra Bank and you will see that 1st of January the stock was trading at around 1900 level and now it has come down to almost 1650 level or 1620 level depending on when you are watching this video. That is almost a correction of 15 to 16%, and you will note that 10 to 11% of this correction has just happened in a matter of a day or two. Now we all know the reason for this correction, but what we don't know is the root cause of that reason. So we know that RBI has banned Kotak Mahindra to do 2 things. Number 1 is stop onboarding new customers through the digital channels, and number 2 is stop issuing the fresh credit cards. And the reason given by RBI is that Mr. Kotak Mahindra Bank, your IT systems are not compliant. You need to meet the compliance, mandatory regulatory compliance. Therefore, until you prove to us that your IT systems are good enough, you can't do these 2 things. Now, this has not happened overnight. This has been going on from 2022. If you read this here, RBI has been examining their IT system back from 2022. So last 2 years, they have been giving them sort of warnings because every year banks go through a full IT audit. I've been working in IT for almost 16 plus years. And I can tell you, not just in India, even across the world, banking is a sector where IT systems are audited once a year minimum. And there are always a lot of red flags that come out. Now, the root cause of this problem of IT systems started back in 2021. For that, what I want you to do is have a look at this commentary by Uday Kotak back in October 2021. And if you read this at that time, Uday used to say that we are a small 2% market share player. And this is the time for us to be taking on whatever it takes, including the cost from getting up our engine up, which is their sales engine. What he means to say is that whatever it takes for us to get new customers, we will do that. And in the last 2 to 3 years, what Kotak Mahindra Bank has been doing is they have been building their IT systems. And when your CEO and MD delivers a message like this with this tone, what typically happens is that their IT team will take shortcuts. They have to get to the IT infrastructure that can quickly onboard customers, and they will cut the corners, because that's what I see with so many clients that I have been working for. So the root cause of this problem is that the company has been trying to build the IT stack very aggressively and trying to cut the corner, which no regulator is going to like. And also let me tell you this, that this is not going to be of weeks of work. It is going to take them months and quarters to fix these IT problems. This does not mean that the Kotak Mahindra Bank is a bad bank. If you look at the data, you will see that their NIM is at 5.22%. Compare it with HDFC Bank, you will see it's only 3.4%. Look at their CASA ratio, 47.7%. Excellent number to look at. Look at their GNPAs and NPAs. Excellent numbers again. NPA at 0.37%, very, very low. However, second big problem I see right now with Kotak Mahindra Bank is its valuation. Have a look at the PE ratio of all these private banks and you will see Kotak is, even after this correction of 15 to 16% year to date, it is running at a highest PE. If you just ignore Yes Bank, other than Yes Bank, if you compare from a PE perspective, 18.33, it simply means that you are paying more price for the earning that the bank is doing as compared to other private banks that are listed here. From a PB perspective, if you see, ICICI Bank is commanding a premium right now, 3.61, HDFC at 2.91, but Kotak Mahindra is at number 3, 2.86. Now, important point to note here is the loan book here. And if we compare the loan book of 3 biggest banks, private banks, you will see that Kotak Mahindra's loan book is 3,72,000 crores. If I show you the ICICI's number, you will see it is in billions here. So I've put 2 zeros behind it. It comes out to be 11,84,000 crores. So ICICI Bank's loan book is 4 times bigger than Kotak Mahindra Bank. If I now show you HDFC Bank, their loan book is, if you again put 2 zeros behind this billion number, it comes out to be 25,07,800 crores, which is almost 8 times bigger loan book. So the point is that you're paying 2.86 multiple of PB, while the loan book of Kotak Mahindra Bank is 1/8 of SDFC Bank, 1/4 of ICICI Bank. The bigger question you need to ask is that, is this valuation justified? Now, the third critical point is, where is the impact to Kotak Mahindra Bank's revenues and profitability? If you look at my screen, you will see 95% of their new personal loans sold by volume are coming from digital channel, and 99% of new credit cards that they are selling it through the the digital channel. So what is likely to happen is that both these work streams will stop showing the growth. And if I show you the data, for example, personal loan, business loan and consumer durables, that has been growing at 33% year-on-year growth, which is almost 5% of their total loan book, is going to get impacted. Point number one. Point number two is, if you look at the credit cards, which has been growing at 52%, the overall proportion of the credit card is roughly 3%. So if you divide 13,882 by 372,464, you get around 3 to 4% of the credit card business, which has been growing at 52% year-on-year, is going to get impacted. So overall, 8 to 10% of their loan book is going to see some material impact in the next 2 to 3 or 4 quarters. Why I'm saying 3 to 4 quarters? That because in my view, it is going to take at least minimum 10 to 12 months for Kotak Mahindra Bank to satisfy RBI if they're able to put right control in their IT systems. So in the next few quarters, when their profitability or their revenues come down, there is a chance that there might be more correction coming our way. So the question you need to ask yourself is that, is this the lifetime opportunity, or is there going to be some more correction coming in the few months that will take the valuation slightly lower, and maybe that is the time for you to take a chance there? Or maybe you want to keep away from this stock, because the second question you need to ask is that, can this stock go from 1600 to 2000? And if it can, how long it is going to take? In my view, next 3 to 4 quarters, I don't see this stock going from 1600 to 2000, because if I show you the chart, you will see that in the last 3 years, if you look at the data, only during October 2021, it has crossed 2000 level. After that, if you see, it has never crossed 2000 level. So my question to you is, even without this correction that has happened, the stock never reached 2011. There was nothing wrong with the stock as such. Fundamentally, if you look at the asset quality, it's looking very, very good. But the stock never crossed 2000 level, even without this bad news. When this bad news actually plays out into profitability and revenues, what are the chances of this stock to go back from 1600 level, that is right now here, to 2000 level? And that is going to be 25% gain. So even if it goes back, best case scenario, even if it goes back to 2000 level, and right now if you invest 1600 level, you will make 25% of profit at that time. After 12 months, I am saying hypothetically. My question to you is that, do you have other opportunities in the banking sector where you can make 25% money within a year or not, is what you need to evaluate. So I hope I have given you a lot of points to consider before you take any investment calls in Kotak Mahindra Bank. So far, if you're liking this video, humble request to hit the like button. Let me know in the comments a simple thank you. That will motivate me to bring more content to you at zero cost. Also, you can consider subscribing to my YouTube member community if you want to get access to exclusive in-depth analysis of stocks and mutual funds. With that, let's move to stock number 2, which is Tata Elxsi Limited. Have a look at my screen and you will see year to date, which is from 1st of January 2024. The stock has corrected by nearly 18%. And if I show you from all-time high perspective, it used to be at 9,000 level back in 18 December 2023. It has come down to 7,000 level, which is almost a correction of 22%. And if you look at the support here, the last time it had hit 7,000 level was back in August 2023, which seems to be a very, very good support level here. And it has taken that support one more time in April 2024, and it used to trade at around 7,000 level back last year in May 2023. So the stock has gone full circle back to the May 2023 pricing in terms of level of pricing at 7,000 level. Now the key question is, what is causing this correction, and is this correction temporary? That is what we need to understand. So for that, let me take you back to few important snippets. First thing is the valuation. If you see my screen, you will see from a valuation perspective, Tata Elxsi after this correction is running at a PE of 55 while the industry is at 37. So there is some natural profit booking here because it was actually overvalued. I mean, from a PE and PB perspective, if you look, even after correction, the PB perspective, it is almost 6 times the industry PB value. In my view, that was anyways very, very high valuation. But this has not corrected just because of valuation. It has corrected because of its fundamentals as well. So for that, if you have a look at my screen, you will see their Q4 results that were recently announced. You will see that their revenues were down almost quarter-on-quarter basis at around 0.9%. And if you look at the profitability as well, Q4 results have got degrowth in their profits. It has degrown by 4.6%. And the biggest problem the company right now is facing is their media and communication business, which is declining at 4.6% year on year. While their transportation business, their healthcare business is growing decently. So that is not a problem. So we need to understand what is going on in the media and communication business. Why is it declining? Is it one-off case, or is it that the entire industry is coming down? If you read the commentary here, what the management team is saying is that this decline that you see is because of one single customer. 4% out of this 4%, 3% is attributable to one single customer. And that can happen to any company, that if one of the client is not giving them business, or their business is down for whatever reason, that is going to have a meaningful impact. But that doesn't mean that the entire industry is coming down. If you look at the sentiments here, what the management feels is that they're pretty confident that they are going to make this up in Q1 and Q2 of the next year. Second problem fundamentally that the company is facing right now is that their EBITDA margin. If you look at this EBITDA margin and as well as the PAT margins, you will see that year on year basis 29.8% has gone down to 28.8%, and from a PAT perspective 23.3% margin has come down to 21%. So there is definitely a hit in their profitability, and the key reason for this profitability hit 1% that we see is what their executive Gaurav Bajaj is explaining. What he's saying is that they are investing in talent pool and getting them AI ready for future, and that is why 80 basis point of that cost is coming from investing in people. Now tell me, investing in people when it comes to IT industry, is that a good investment or bad investment? Naturally, it's a good investment and it is going to give them value in the upcoming quarters. What about the future guidance? Here, the company is not giving any specific guidance in terms of the numbers, but they seem to be pretty confident about the business coming back to its track in terms of the profitability and the revenue growth in the next year. So in my view, Tata Elxsi, this correction of 22% looks very, very good. Could it fall further? Well, some of the analysts here see that there may be another 20% downside, but please know that this is all in the media. You may believe this, you may not believe this. This is up to you totally. And if you believe in Tata Elxsi's growth story, then you need to think about splitting your investment into multiple chunks, because nobody can pinpoint the exact bottom of the stock. But this 22% in my view is a very, very good correction. Do not take this as a stock recommendation. I have simply presented facts to you and have helped you understand why the stock has corrected and what are the future prospects looking like at this point in time. Let's move to stock number 3. And I'm not going to speak about a stock, I'm going to speak about a sector that is struggling right now. Have a look at my screen. Very recently on my YouTube member community, I created a detailed, comprehensive post about paint sector. There I spoke about Asian Paints, Berger Paints, Narrowlag. They are all down by 16% year to date. And when it comes to paint sector, there are two types of investor. Investor number one is the investors who ride on the cyclicity of the stocks and make good money. And investor type 2 are the investors who want to keep away from the paint sector because of cyclicity of the stock. Let me explain to you in a simple 2 to 3 minutes of commentary entirely about the paint sector. What you see on my screen is Asian Paints chart history. You will see in the last 3 years. From around May 2021, you will see a very good cyclicity here. Stock goes up, comes down, goes up, down, right? And if you buy the stock at the bottom price, what is likely to happen is that in the short term, you stand a chance to make some money. Definitely, that is investor type 1 if you understand the cyclicity. More importantly, the volatility within the cyclicity is very high as you go down to the lower level stock. So for example, Asian Paints, you see this picture here. If you go to stock number 2, Berger Point, which is number 2 in the industry, has shown even higher volatility. So from here it has gone up, come down, and then gone back up and again coming down. Stock number 3, which is Narrowlag Paints, again third in the industry, you will see has even shown further cyclicity or further volatility within the cyclicity, that it has gone further up high and come down here. Point is simple, that if you can accumulate the stocks at the bottom prices when it is correcting, then in the short term you stand some chances to make money. That's what the charts are showing us in the last 2 to 3 years with all these paint stocks. But if you are a type of investor who doesn't understand this cyclicity and doesn't want to take a bet within this cyclicity, then you might want to keep away. So what drives this cyclicity? 2 quick points there. Point number 1 is fluctuating oil prices and the ingredients that paints industry use. So there are more than 300 plus raw materials, the commodities that the paint industry use as an input to manufacture the paint, and their prices will invariably change in the global environment, and therefore the paint industry in the last 2 to 3 years have shown a very good level of cyclicity. So if you are able to understand these prices or at least able to track oil prices, then yes, you have a chance to make money in paint sector. Otherwise you should just keep away from from it. Point number 2 is the economic sentiments or economic growth, because paints is a consumption driven commodity or consumption driven item, and depending on what is happening in the economy in terms of the rural demand, urban demand, you will see the paints demand going up or down, and therefore this leads to the cyclicity of the stock. So the point I want to drive home here is that timing is the key when it comes to the paint sector. That's what the data is showing us in the last 2 to 3 years. And right now, since the paint stocks are down, it may be a good time for people to start accumulating this, because it may have some upsides, but there are also few risks that we need to understand right now. Risk number 1 is right now Iran-Israel standoff going on, and it might turn into a full-fledged war. Nobody knows. That is going to take the oil prices up. It's already up. And when that happens, it is going to impact margins of paint companies, because their input cost to manufacture the paint is going to go higher. So that is an imminent problem right now. That is why the stocks have been correcting. So this, to me, is a wait and watch situation. Nobody can predict it. So you need to really be patient with this. Point number 2, or the big problem right now paint sector is facing, is the multiple new entries that is happening into this sector, because this sector is looking very, very lucrative right now. That is why Grasim's has taken entry into it, right? That is why Pidilite is coming into it. Now, the important point here to understand is that when JSW Paints came into the market in 2020, after that they are now at 2000 crores run rate of revenue. They have not eaten the market share of Asian Paints. So you need to put this in context as well, that when the Grasim is coming into this market, and the projection of the Grasim industry is that they are going to take their revenues to 10,000 crore level in the next 3 years. The question is it going to eat the Asian Paints market share, or Berger Paints market share, or Nerolac market share? In my view, there is going to be some impact, but I don't think it is going to be a huge impact, because there is something for everybody in this industry. Yes, there is always a threat here that the Asian Paints market leadership might be in trouble here. And also try and understand why these players are entering into the market. If you look at the rationale that Grasim is giving, that they're saying that there is a correlation between paint sector and the economic growth. So if economic grows by 5%, then paint sector is likely to grow by 10%. That is why they are taking these bets. So I don't think that makes paint sector is a bad sector. But right now, these two problems, which is Iran and Israel war, and the second one is that the multiple entries right now, the sentiments are really low right now for paint sector. So what should you do in my view? In my view, if you want to take fresh entries, maybe target those stocks that are running at relatively lower PE and PB than the industry, because the chances of them correcting is less versus the industry leaders such as Asian Paints or Berger Paints. Again, this is a very broad view I have given you. You have to decide based on this analysis whether you want to take any bets into the paint sector or not. With this, I come to the end of this video. I hope you enjoyed this video. I'll see you in my next video. Until then, keep rocking.